just get them in. So hello, thank you for joining all of us. Great, I'll do the introductions. So I'd like to introduce you to Edward Kirby, who runs Sleek Accounting. Ed's going to run through setting up the company in the UK, company taxes, tax incentives to investors. I mean, we've spoken about these a bit, and also his own journey as an entrepreneur, because that's really part of why we work with Ed. From my point of view, Ed and his team have loads of experience and a really agile accounting firm. I think that might be the right term to use. And they've worked with many of our companies expanding into the UK. I think most importantly, Sleek is actually our accounting firm, so I've got lots of personal experience as to why they're good. Most recently, when you did our R&D tax credit form, and it was really great. I mean, that is a complicated thing to do, and you guys got it spot on. Ed, if you want to start, I think what we'll do is we'll try and keep this really informal. So jump in with questions at any point that you want. And I mean, I've got definitely ones that I would want to jump in with just to reinforce. So yeah, let's keep it informal, and we'll do also Q&A at the end.
Perfect. Thanks, Simon. So yeah, like Simon says, very, very happy to keep it informal. So jump in, ask any questions, put your hands up, whatever, anything like that. So yeah, I'm Edward Kirby. So I'm the UK head of country for Sleek, which is a fintech accounting firm. So just a little bit about Sleek. So Sleek in the UK is been here. Well, essentially bought my business, AccountsLab. So I set up a company, a cloud accounting firm called AccountsLab about 5 years ago now, and set it up from my kitchen table. Didn't raise or anything like that. So bootstrapped it over the 4 years until I was acquired by Sleek. So stayed on, obviously became the head of the UK. All my staff were part of the UK, and now we're just growing, but we're a VC-backed business. So Sleek has the UK, which is my remit, everything there. We've got an office in Hong Kong, we've got an office in Australia, and we've also got an office in Singapore. So basically our mission at Sleek is to digitize and make the whole process of setting up a business and running the finances and the back end of the business as seamless as possible. So that's whether that's just someone, a side hustle, setting up a company and working from home on the side, or a VC-backed tech startup, doing everything like that. So in the UK, we've got offices in Leeds, Manchester, and London, but we've got staff all over the UK because everyone pretty much works remotely and from home now these days. So yeah, that's Sleek. So a bit about me. Hopefully I look a lot younger than I am, but I've got 20 years experience in this industry. So originally I've studied law and taxation and went straight traditional route into a top 5 accountancy firm, Grant Thornton, where I did my tax exams. Basically, big company culture isn't really for me, and my whole life I wanted to set up a business, but I didn't really know what. So I quit and started advising high net worth individuals on tax and lots of different things and other businesses. And then I decided to set up a cloud accountancy firm myself. So I'm not actually an accountant. I specialize in tax, but I see myself more as an entrepreneur. So I set up a cloud accountancy firm, hired some accountants, and just kicked on there. Unintentionally, I built out a niche myself, advising startups. So I advise any businesses that raise anything from 10,000 to, I think my largest client raised 150 million and ended up IPOing in the US. Wow. We've looked after everything in the UK for them. So we can help with, we don't help with getting funding, but we have a very, very broad range of contacts. If I say, if one of you guys are in, for instance, the gambling industry, I say, I know this guy, speak to this person. But we can help on the tax incentives, the advising, and everything like that. So yeah, like I say, I know what you guys are going through and having to do, set up a business and grow a business. I've also advised and sat on a couple of boards of 2 fintechs where I've exited from one, in addition to Accounts Lab. The other one, I still sit on the board. I've had a chain of retail shops on the high street that I've exited from. And then I'm also in talks with sports media at the moment. So I have lots of advisory capacity and lots of things going on, not much time. So that's a bit about me. So what I like to think is not just your boring traditional accountant, and as an accountancy firm, we know where you're coming from. We know what you're trying to do. We know what you're trying to achieve, and we're trying to help you as easily as possible to get that. Okay. So company setup in the UK. Pretty simple, really, setting up a company in the UK. Companies House. So what I will do, before I go into that, right, I'm going to caveat the whole of everything I'm talking on the slides, in that there are a lot of changes going on, and we're going to get an election this year, Simon, right?
Yeah, that's correct. Yeah.
Okay. So sooner rather than later, I don't know. I saw people were trying to get rid of Rishi last night, but we're going to get an election. There won't be huge changes to some of these things I'm going to talk about, but there will be some changes, right? So maybe I'll tell you about corporation tax rate, and that's going to change. We're going to get a budget before the election as well, and we're always going to get taxes reduced in a budget prior to an election. So some of these might change, and be aware of that, but nothing will drastically change now, because they won't be able to get it through before an election. But after, which there should be a Labour government, they might change certain things.
Yeah,
so,
and the basis of company setup and compliance would stay the same, really, wouldn't it?
Should, but that's what brought me onto it. They're going through big changes as well at Companies House with trying to do different things. They're trying to put through some legislation. Well, it's not going to change the premise of setting up a company. They're just tightening up things. So, for instance, they're just making things a lot more professional, which won't affect any of you guys, and it makes it better for advisors, really. So it's quite easy in the UK to set up a company. It's not like some countries like Singapore, which is where Sleek kind of began and why it was created, where everything was very, very paper-based. There's always been digital incorporation for a long time, but it can be quite confusing doing it at Companies House yourself, and their user interface isn't very easy. But it's a very, very simple process in the UK. Very quick if you get it correct and right. If you don't get things correct in the UK, then everything takes a long time to prepare. But really, we set up companies for literally a couple of £100. We can do that. We need the directors, we need the shareholders. All the information goes to Companies House. So directors, shareholders, what the company is going to do, and then that will be submitted, come back electronically, hopefully within 24 to 48 hours, and there you are. You have your company, you have your certificate of incorporation. You don't need a lawyer in the UK to set up a company. Some lawyers say, like, I love lawyers. Have we got any lawyers on this call, Simon? No. Lawyers are great. You need lawyers, but I can see from your perspective, guys, you need to tally up between how much you're going to spend on lawyers before you business gets going and not. So they're very good, but when are they good, and when do you need them? So
yeah, I think that's a really good point, because for the basis of setting up a company and being operational in the UK, you do not need a lawyer. Yes, you're going to need a lawyer if you get into some complexity of company structure or shareholder agreements between different partners, or when you take investment. But to set up and get yourself going, you don't need a lawyer. So it's not like other countries. And there are advisors to advise companies coming into UK that will walk you into the lawyer's office and charge you way too much for setting up your company. As Ed said, he can get you set up for cheap and quickly. That's
perfect point, Simon. Some lawyers will say, look, you need bespoke mem and arts, you need a massive shareholders agreement. Why do I need a shareholders agreement if it's just me and my business partner, right? If it's just and we're trying to raise, right? Yes, you need one after if you raise whatever, you know, a few million, but all of that, there's no point spending 10, 20,000 pounds if you pre-revenue, if your, you know, funds are tight or anything like that. So they do have a right point, but not initially. So, so yeah, on incorporation, then your company is set up, and then you have certain obligations in the UK. You have to submit company accounts, which are a 12-month period. Or well, you can extend and shorten them, but normally it's 12 months. There is no set accounting period. So in the UK, we have a strange tax deadline, or the tax year, which is the 5th of April. So it runs from the 6th of April to the 5th of April, but we don't have a set year for accounts. So it goes from the month that you set up. So if you set up now in January, your year end would be the 31st of January. So it runs from the 24th of January to the 31st of January 2025. You can shorten or extend it, and most people either run it to March, so it runs almost concurrently with the tax year, or they change it to December, so it runs with the calendar year, just purely for ease. So you can shorten it or do it, but you can have whatever you like, really. So that's your company accounts. They need to be prepared and submitted to Companies House and HMRC. Companies House have a record of those accounts, and at the moment they show abbreviated statements, so an abbreviated balance sheet, which is open to the public, so anyone can see that. Not much can be taken from that abbreviated balance sheet. Yeah. But a heads up, one of the changes that they're talking about going through, which I was just mentioned earlier, is they're talking about publishing full accounts online that anyone can see. So anyone can see your P&L, things like that. So whether that's good or bad, I don't know yet. I think it's bad, to be honest. You know, you're going to get bigger companies screwing smaller ones if they realize they're small and not having too much profit, etc. You're going to get people snooping. Anyway, who knows? So that's in the talk. So you've got 12 months to do your accounts, and then you have to do what's called a corporation tax return. And the corporation tax return is another 12 months, and you have to pay your so you have your accounts, which are a 12-month period. Then you have 9 months after the year to submit your accounts and pay your tax, and also do your tax return. Okay, your tax return has to go to HMRC, and that essentially says this is our profit or loss, and you do all your tax calculations. If you make a profit, you pay tax. If you make a loss, there's things you can do with your loss. So that is what you have to do every year. On top of that, you have to do what's called a confirmation statement, and that is an update to Companies House of who the directors and shareholders and people of significant control are in the business. So there's no hiding behind corporate shareholders and trusts and everything like that. You have to say who the ultimate person's in control. Normally that is pretty standard every year, but sometimes if you're a fast growing business like you guys and you're looking to raise and you get different shareholders, then it can be quite complex when you submit the confirmation statement. So it could be 1 year, you know, on incorporation, Simon's the shareholder, but when you do your confirmation statement next year, you've probably got all sorts of VCs and angels and things like that that you have to put in and update. But it should be straightforward. So that's your obligations. All of that
just to jump in on the confirmation statement. I mean, I've done them. They're easy. You know, it'll take an hour.
Oh, top.
You know, it's
dead easy. It's just if you've got a lot of shareholder movement, it's just making sure it's correct and it all adds up. But if you don't have anything going on with the share structure or directors of your business, it's, you know, it's not even an hour. So that's the company setup compliance. Everything done electronically, everything submitted electronically, you know, gets acknowledged straight away. Things can be done on paper, but I wouldn't even know how to do things on paper these days. So UK taxes in the UK. Yes, Sandeep.
So before we go to taxes related to that, would you be the type of company to be set up? Because most of us have businesses overseas. And is there a difference if we set up a subsidiary, a branch, or, you know, the type of entity to be set up over there?
Right. So this is a big decision you'd have to make, and I probably wouldn't be able to give to the details in this call. But if you've got a branch, if you're operating overseas and you're setting up in the UK, then I'd recommend setting up a subsidiary. Well, I'll caveat that in a second, right? You can either recommend setting up a subsidiary, so shareholder will be, let's say, you know, French company, will own the share in the UK company, and you'd have the directors, right? Very, very simple. Money can go between the two as a group. That is what I'd think of. The only thing you do need to think about, and I'll touch on this at the end with regards to tax efficient investments, is if you're trying to get investments, and the UK is very good and has very good incentives for people investing into startups. So, you know, a lot of VCs are backed or anything like that. Will they invest in French holding company that owns all the shares? Because that's where they need to invest, you know. So basically, you might be dictated to where you set up. So it might well be that you set up the company in the UK, which then holds the subsidiary in France, for instance, because you're going to be getting income, you're going to be getting into investment into the UK. And to give you a very good example of that, Y Combinator, which you've probably heard in the US, they always insist that any company that they go into sets up a US Delaware company that they invest in. So even if it's a UK company, let's say Sleek, they'll say, right, you have to set up a Delaware holdco, we invest into that, which owns Sleek. So yep, subsidiary is the thing, but UK might be top code depending on it. So yes, Daniel.
Because my only related question is that your first line on tax, right? That tax is on the profits in the UK and abroad. And obviously, UK tax rates would be much higher than, say, in Singapore and others. So
it'd be where profits are. Okay, so profits within that company. So if you only have a UK company, profits will be brought into that UK company. So so what I'm trying to say is, if you're, it probably doesn't. That's not worded that right on there. So you're taxed on the income. So if you've only got one limited company, but you're trading all over in the UK, but you're trading all over the world, then everything's taxed in the UK. Okay, but if you've got a French company and a UK company, and all the income is going, I mean, this is going quite deep into it, but if you have two companies that trade differently, then you have to have tax treaties, and you have to have lots of different transfer pricing agreements between the companies, because what you can't do is set up in the Cayman Islands, right? Divert all your profits to the Cayman Islands and not pay tax over there, right? So what we're trying to say is tax in that company is taxable in the country where it lands, really. So it might, yeah.
No worries. I'll set up a separate call because those are the key considerations for us.
Yeah, great stuff, Sandeep. Great questions.
Yeah, cool. Daniel?
Yes, I have following questions to this one. We are thinking to create the subsidiary for first, but then when we're thinking to switch the shares between those companies, it means that the mother company basically will be first, if we will create a subsidiary which will be owned by 100% of a Czech company, Czech entity, then we want to, because we have also some convertible loans still behind this Czech company, we will have to make it clear, and then we want to switch the shares. It means that the UK company will be owning the Czech company, which later on will be subsidiary. And if it does work well.
It does work, but what you need to do is so in the UK, if I set up a holding company and I wanted another company to be the subsidiary, and I wanted to what's called a share for share exchange. So instead of, let's say, me owning the shares in Sleek UK, I'd want Sleek Holding Company to own the shares in Sleek UK and me to own the holding company. So you're basically standing in the same shoes. So you're saying you want to put the UK company above the Czech company, yeah? Yeah. So what you need to do is, I can't advise on Czech tax, but you need to make sure that when those, so let's say you, Daniel, own 100% of Czech company, you want to own 100% of UK company that owns 100% of Czech company, yeah? What you need to make sure is, when you dispose of those shares in the Czech company to the UK company, because they'll need to be disposed of, they'll need to be sold to the UK company, which owns them, which then you shareholders will own that, then you'll need to make sure that there's no capital gain triggered on that. Hey, in the UK, there's not a capital gain as long as you ask HMRC, because you're saying, look, we are disposing of shares, but the ultimate shareholders remain the same and we're standing in the same shoes. So it's called what's called a share for share exchange. In the UK, we have to get clearance and a tick box exercise for that. In Singapore, they don't, but I don't know the other countries. But you might need to be careful on that, Daniel, in that some of your investors or the notes or something like that, do they want to be shareholders in a UK company? Will they lose any reliefs, etc., etc., etc.? I don't know.
Yeah. Okay. Probably we will take a time, and if possible, we will make some offline discussion one-to-one to discuss what will be the best structure, because we will have also one specific, and I don't know if it's related also to set up a company in the UK, because what we are doing, we are selling the tokens, to the customers. The tokens are connected to the properties across the Europes, but it might be some licensing for a company who can sell the tokens on the UK market, and might be some special company, I don't know yet. And maybe you
it's all trying to get what's the best, and sometimes also the best, but sometimes easiest as well. Sometimes if you talk to lawyers and accountants, everyone can get a bit bogged down. You can take a step back and say, look, we're tying ourselves up in red tape, and it could cost a fortune.
So also there's something here that you mentioned, Daniel, which is you can start off with one and change to another. And a lot of times it might be down to, well, I know in your case, looking for investors and what structure investors want in the UK, but you've got your legacy investors in Prague as well. So
that's what you consider. You legacy investors plus new investors, where's they want to be invested in, where's the companies and everything like that, because you never know. Like if I'm investing in a company and it's like for like, am I going to invest in the UK company or am I going to invest in the Czech company? I'll invest in the UK company because it's what I know. So Okay. So just to rattle through this one then quickly, you got two taxes in the UK: corporation tax, which is on profits. So, not turnover, anything like that. So we're talking profits. So, turnover less expenses equals profits. So over £250,000 profit, it's at 25%. Under £50,000 profit, it's at 19%. And between those is kind of marginal relief where it's staggered. Again, I can see that changing. Probably not. I can probably see income tax changes before this, but that 25% was only recently introduced, so it could be scrapped. But really, it's quite a lowish rate of tax, marginal, like corporate rate of tax, 19%. I know Ireland has it very low, which is a lot of why Google and those kind of companies set up in Ireland. I think it's like 12, 13%. But, it's not too bad, 19% tax to 25. So,
Just quickly, Ed, so if you don't make profit, if you're loss making.
So if you're loss making, you can carry forward your loss indefinitely and set it off against future profits. Or in certain instances, you can surrender your loss for R&D repayable tax credits, but that's very, very niche point that we need to discuss. But your losses aren't lost. You can carry forward them indefinitely. So, if you have the first few years whilst you're getting going and you're making losses, they can always be carried forward and set off as long as it's against the same trade within the business. So that's corporation tax. And then you have VAT within the UK. So VAT, GST, and a lot of other countries, exactly the same thing. So it's pretty much added to most products and services, but there are some that aren't. So there are some very niche products. Well, not niche products, but you always kind of need to say, are we VATable? What's our VAT rate? So for instance, certain foodstuffs are an absolute nightmare. Biscuits, cakes, coffees, eaten in takeaway, absolute nightmare. Books, children's clothes, kind of healthcare products. Lots of these things might be 0 rated, no VAT. Difference between no VAT where you don't charge it and where you charge it at 0%. So there are two differences as well. But not to get bogged down on that, standard rate 20%. I send Simon an invoice for £1,000. It's £1,000 plus £200 VAT. If Simon's VAT registered, he can reclaim that £200. Okay, very, very simple. The VAT turnover is threshold is £85,000. Okay, you don't have to register until you hit that turnover threshold. If you are B2B, you might want to consider, so B2B, I mean business to business, you might want to consider voluntarily registering straight away, because if you're invoicing VAT registered businesses, they don't care and you're adding VAT on top because they can reclaim it. And the good thing about that is you can then reclaim VAT on all of your expenses. Okay, if you're business to consumer, you don't want to voluntarily register for VAT because common sense says that you're charging someone the maximum that you can already. You're not going to automatically add 20% on top. If you can do that and not lose any clients, I've had this conversation many a time, you should be charging your clients that price already, right? But so you're not going to add that on top, so you're going to have to take a hit on your margin by 20%. So really, B2B, register voluntarily, B2C, wait.
Yeah, I mean, there's another thing that my father taught me, which is register voluntarily, because if you don't and someone gets an invoice, they know that you're turning over less than 85 grand.
I mean, that's a good thing as well for optics. As having a limited company as well, I have lots of people who are like, you know, bordering on, you know, should I register a limited company? Should I not? I'm like, well, it does look good for the optics as well. But you do need to work that one out, right? There are lots with the 85,000 threshold. There are lots of plumbers and things like that in the UK that get up to £83,000 and down tools. I mean, I doubt they down tools, right? They probably just take cash, Simon, right? But you know, they down tools because they don't want to
halfway through a job.
Yeah, exactly. They'll be like, right, pay me cash. But you know, there's that thing. But as a serious business wanting to kick on way past that, VAT should be registered. Okay, this is a very, very important point, and something that you'll be, unfortunately, you know, tear your hair out with, is setting up a bank in the UK. It's easy compared to the rest of the world sometimes, but it's still hard, especially as foreign companies, like foreign directors, foreign non-residents, to set a company up. Unfortunately, us as accountants or advisors can help you as much as possible, as in point you in the wrong direction, but we can't really do much for you in that. In Singapore, for instance, and some jurisdictions where you need a local director, so that's a point I should have probably mentioned about the incorporation. You don't need a local director in the UK. So, you know, you could be Daniel, you know, a director from Czech Republic in the UK. That's absolutely fine. You don't need someone on the ground. Whereas some countries you do. You need Singapore, you need a local director. Okay, so where they have a local director, that director can then help set up the bank account. We can't do that in the UK because we're not directors of your company. So would you rule out high street banks completely, Simon? I probably wouldn't rule them out completely, but
I think, well, banking is another issue which we tend to deal with a little bit separately as well. I mean, obviously, I think everything on this slide makes perfect sense, and I think the challenger banks are the way to go.
Yeah.
We have connections with certain high street banks that kind of are interested in overseas companies coming into the UK. Sometimes they change and they go, no, we don't want to touch these guys. A lot of times they want a connection in order to set up the banking. So we have two people who help us with banking for companies coming in and advise them, and they've got the connections to the bank, and it's a changing landscape. Sometimes HSB will want the conversation, and then 6 months later they won't. Silicon Valley Bank was great for us. They're now HSBC Innovation, and last time I spoke to them 2 weeks ago, and they're just getting up and running in order to offer services to scale-ups coming into the UK. So they're really interested. They're just not there yet. Yeah. The challenger banks are a really great start because they're so easy, so quick.
So my thing from this, so the takeaway from this, guys, is as soon as you can't set up a bank until you've got your company, but as soon as you have that company, start getting going with these banks, right? Because it can take time. So do not leave it and think, oh, you know, we're going to start trading and haven't got a bank account, right? Get those bank accounts set up, and maybe a dual, you know, approach in a high street bank, maybe along with a challenger bank like these. And Wise is particularly good sometimes. And if you've got other companies abroad where you're wanting to, you know, put money between the two, then that might be quite good. So you can use a foreign currency as well. So I know us at Sleek, I have Barclays and I have Wise. Wise for sending money to other Sleek companies and back and forth across the group. And the Barclays one because it's a UK high street and it's our traditional one. But really, don't leave it too late. Some might ask you for, it might be one of you guys will find it's completely easy, one will find it incredibly difficult, and it's the same bank and the same person. You just don't know, but don't leave it to the last minute. I think that's really
Yeah,
the
I
only
mean,
thing
just to end on this, one thing that we do find smooth things out is if you're with a large international bank in your home territory, that can kind of help when you come here, but not always. So and think of 2 months for the process of setting up a bank account. It could take that long. Honestly, you use the Challenger Bank, you could be up and running in quite a short space of time. But we've had situations where companies coming in have, let's say, there's been put on a naughty step and they can't get out, and they need real help to set up a bank account. So the general advice, and this has gone around every organization I've worked with, is, I suppose, talk to us before you start, and then we'll try and introduce you to the people who can help.
Yeah, it's just a difficult one, and sometimes there's no rhyme nor reason why it works with one person or another. I tried to set up a bank account with Barclays for a business for myself, and I banked with them business-wise for a long time, and they said I had to come in and sit down with like a 20-year-old and talk him through my business plan. It's like, okay,
crazy.
Right? But anyway, so yeah, but once you get these banks, it's a good environment. There's a lot of, it's very, as you'll know, probably a healthy fintech scene here, apps, foreign currency, etc., etc., etc. Very good. Okay, so these, I think these are very, very good. I'll talk about the Seed Enterprise Investment Scheme, SEIS, and the Enterprise Investment Scheme, EIS. I'm not sure if they have any similar things in other countries, but these are very, very, very attractive in the UK to investors. It's got to that stage where sometimes people won't invest to early stages businesses unless it is under this, because it just comes off so much risk and it's just so attractive. When I invest in businesses, they have, to me, I'm only going to do SEIS or EIS. Okay, so
yeah, just on that point, I mean, last time we raised for ourselves, when we raised our SEIS, we did a pitch, a room full of investors, hands went up. We thought they've got really great questions about our business plan. They all said, "Are you SEIS?" Because they just want the tax break. As long as you're convincing enough, it was just all about the tax break. And we went, yes, of course, we're SEIS.
It just covers up so much risk, right? If you invested in two companies, I mean, you just wouldn't look at the other one if they haven't got it, because it just... Anyway, so SEIS stands for the Seed Enterprise Investment Scheme. So what it is, it's to encourage investments in early stage startups and to fuel innovation. So to be SEIS, you need to be a UK-based company with a permanent establishment. Okay, so the UK-based company doesn't mean that the investment, and this is where there's lots of conversations to be had on this separately, but I could technically invest SEIS into a foreign company as long as it had a establishment in the UK and an agent in the UK. Have I ever seen anyone invest in a foreign company under SEIS? No, because in the UK, they'd probably rather invest into a UK company. But technically you can, and HMRC will give clearance to that, because as long as it's got an establishment in the UK, it's benefiting the UK. But essentially, what it is, that investor, so for instance, Simon invested into one of your business, what he does, that investor gets 50% income tax relief as long as they've paid that tax straight away on that investment. So £100,000 invested, you get £50,000 income tax relief back as long as you've paid that tax. So automatically, right, you've covered off 50% of the investment. Also, as long as you hold those shares for at least 3 years, whenever there's an exit, so if you become the next Facebook and there's an exit, IPO, something like that, and it goes 100x, there is no capital gains tax if you invested under SEIS. So that's absolutely brilliant. Okay, capital gains tax in the UK is 10 or 20%, but more often than not 20% if you invest in. So that's a game changer as well. If the company goes bust, unfortunately, which, you know, these early stage businesses are risky, then there's also loss relief. So the second 50% that you didn't get the first lot of relief on, you get another 50% relief to offset against your income. So I think, I don't know the exact figure, I was talking about this the other day, I need to work it out, but let's just say, essentially, if you put 100 grand in and the business goes bust, you stand to lose only, let's say, 25 grand of it, right? So that is why it's so attractive to investors to invest in these SEIS businesses. For a company, well, the investment for the subsidiary, Sandy, so that's the problem. The investment has to go to the top co, and the top co can be the foreign company, and an investment can go into there, but it's harder, and I wouldn't invest into a foreign holdco, even if it was, you know, qualifying for SEIS. You got to think, right? How many people are asking for money out there? So many at the moment, right? How many get it? It's tough right now. So you've got to make it as easy as possible for an investor. So if I had two mirror image identical investments, am I going to invest into the French one that I don't really understand French companies or anything like that, or am I going to invest into the UK one? UK one, easier.
And this comes to a separate point, Sandeep and everybody, which is investors. I mean, the investor landscape is disrupted at the moment, so it's not particularly great. It's getting better. Investors like companies with traction. So really, for you guys, because you're all scaling up, really, investors will be interested in you because you're already international, but then you're riskier here because you don't have connections and partners and traction in the UK market. So first phase could be subsidiary, get some traction, start speaking to investors, become investor ready, which will all take time, and then flip when you know that investors are interested in you. I mean, that's the perfect scenario. Timing's become an issue with that because of financial year ends and all this sort of stuff, but then we get into a bit more detail. But my advice at the moment would be what you all should be thinking about is traction and investment and how you're going to achieve both, and then what period of time those take. And that obviously, that's where we can, and our partners can help with all that as well. Hey, Andrew.
Hi guys. Just a question. The investors who are benefiting from this SEIS, do they have to be UK-based investors, or they could be international?
Well, they don't have to be UK-based, but they have to do a UK tax return. So what it is, it's not money for nothing from the UK government. So they have to have paid tax in the UK, and they have to have paid that amount, right? So I've come across sometimes people who've had inheritance, right, and they want to invest it on a £20,000 salary. If they invest 100 grand, they haven't paid 50 grand tax in that year, so they can't get £50,000 tax back what they haven't paid. So they have to be. There's more often than not UK angels, high net worth individuals, because you need to pay the tax in the first place to get the tax back.
Got it. Thank you.
Yeah. Another question?
Come on, Daniel.
Yeah, may I have one more?
Yeah, of course.
We are thinking, even it's probably the VCs doesn't like it, but we are thinking to try the way to invest small round or some bridge round through the crowdfunding platform like Seedrs. We heard from Marco that the VC investors hate the crowdfunding platform, but we will investigate it anyway. Is it possible that the people will get this release?
Absolutely, yeah. Under the crowdfunding, a lot of them on there, you'll see on Seedrs and Google, whatever, you'll see SEIS and EIS approved on there. So 100% they would. Just be careful on those. We're deviating a little bit. You have to have a big kind of investor already that you can bring to the table with those. You can't just go to like seeders and say, I want to raise £1 million. Let's go out to you have to say, I want to raise £1 million, but I've already got these people who are going to commit 300-400 grand to it, and we need to top it up through seeders. So you need to have people leading it through seeders. So it's quite a difficult thing to do. And some investors don't mind it. Can be a bit of a messy cap table, but sometimes I think they have someone on there. I don't know. I'd probably go seeders if it's a product-based thing, because then, I mean, this is just me going off piece and me talking from my experience. I'd probably go seeders from a product base, because then you've got a lot of, 1,000 ambassadors for your products that are buying it, selling it, advising about it.
Yeah.
If it's service-based kind of thing, not too sure. Can be more hassle than it's worth.
Yeah. We are also thinking to use the seeders as a market entrance, that they show that the traction on the market, because might be easier for us to show the potential on the market through the seeders. And we cooperating with the Robert Musko. We will have with them the agency who is one of the recommended company for preparing the materials for seeders.
Yeah, I know Robert Musko actually. Yeah. Okay. Yeah.
I mean, Daniel, I mean, it makes sense. I mean, you do end up losing a bit to the platforms, obviously. Ed's absolutely right. You need to start with people on board, and you almost need to feed other people coming in, so it just doesn't look like the round's dying halfway through the process. I know there's one agency I know and trust who do your campaign, and Stephen does have a network of investors who may start the round as well. So email me and I'll introduce you to Stephen. He's good, and he does all your marketing and all your social. He's based in London and Birmingham, but they've grown quite a lot. It'd be worth having a conversation with him. From the conversation, he would immediately tell you whether you're going to stand a chance on crowdfunding or not.
Okay, perfect. Thank you very much. We will do. Andy, please make a note. I'm in the car. Thank you.
Yeah.
Thanks.
Okay, fine. So last thing on the seed enterprise investment scheme. So it's for the first 3 years. You can raise under that. You can only raise £250,000. Okay. So the next one is what's called the enterprise investment scheme. So the enterprise investment scheme is pretty much exactly the same to the seed enterprise investment scheme, but instead of 50% tax relief, the investors get 30% tax relief. The reason being is these are for more like larger, bigger businesses that aren't, just starting out, that have that traction. And you see there's certain things to it. In that you can't have gross assets exceeding 50 million, et cetera. There's certain staff limits to it, but these are larger businesses, but you can still raise under it. EIS is also an option. And what you'd also need to do, I do come across some people trying to do these themselves, and sometimes accountants and lawyers are not experienced in this. So we're very experienced in SCIS, EIS, and I think we're fantastic for it. If I have an elderly couple send me an email saying, "Hi Ed, we're worried about inheritance tax," I hold up my hands and say, "Look, I haven't got a clue about inheritance tax and those kind of things. We can't deal with it." So just be careful in who you appoint and for what, right? So for instance, SCIS and EIS shares can't be issued on the same day. That's one of the points. So if you're raising, let's say, £1 million, I'd probably give first 250 pledged to SCIS, second 750 to EIS. But I've seen accountants or whoever issued that £1 million worth of shares all on the same day, right? So it means that the SCIS isn't qualifying. So you'd have to do 2 small issues of shares on 2 separate days, right? £250,000 worth of shares on one day, then next day the EIS ones. So there's lots of little, so on the face of it seems simple, but there are lots of little nuances. So just a heads up, whoever you use, whether it's us, whether it's someone else, or whoever, there are certain things that can trip you off, and there's nothing worse than an investor realizing they're not going to get their tax relief. It's pretty bad.
Yeah, so, and just to add on that, a strategic point though, sometimes it doesn't always work like this. If you come into the market, gain some traction, get to know people, you might find people who you would like on your board, and you can say, okay, well, let's do SCIS for that group. So it's a little bit more attractive to the people that you want circulating around the company and give them some skin in the game to help you move forward. And then the EIS shares certificates for the other investors just with money.
Yeah, there are lots of things you can do for that. I've seen it a couple of times, so I always advise on this is basically first mover advantage. Who wants to pledge the first 250? You get the 50%. Everyone else that follows, you get the 30. So it's getting people to put their money where their mouth is, really. So they're fantastic. So you can see the difference is 50 and 30%. Organizations, well, this is what I was just going on about. SEIS traded for less than 3 years. EIS have to trade 7 to 10. But that's a point under EIS is once you've raised under it, then you can raise under it indefinitely. So it's not a 7-year limit to raise under it, but you can raise under it indefinitely. Okay, there's certain different rules as well about if you've raised under one trade and tried to change to another, and it has to be significantly different within your business. So I had a large pet food company that was going from dog food to cat food, and they were trying to say it's completely different, it's a different trade, it's a different chemical makeup, etc., etc. HMRC weren't having any of it, but there's lots of different things. Okay, right, advance assurance. This is incredibly important, and it's really important. Okay, advance assurance is what all your investors will ask. And they'll say, do you qualify for SEIS or EIS? Have you got advance assurance? Advance assurance is going to HMRC and saying, excuse me, is going to HMRC and saying, this is all our information about our company. Can you confirm if we qualify for SEIS or EIS? Okay. To send them that, you have to send them a business plan, pitch deck, cash flow forecast, and name of a potential investor. That investor doesn't actually have to invest, but what HMRC were doing, they were getting tens of thousands of applications, never coming to fruition. So they thought, right, to actually cut these amount that we're getting down, we're going to have to get people to name someone that they think might invest, so they're not getting so much. So this advance assurance is very strange in that it means everything and it means nothing, right? And I'll explain what I mean by that. It means everything to the investor, because what it's telling the investor is you've gone to HMRC and you've said, this is everything about my business. Please confirm that if we do raise money, you think it will invest, you think it will qualify for SEIS or EIS, okay? And if I see that, it gives me some comfort when I invest in the business. If you don't have that, I'm not going to invest in the business and no one else will. What HMRC, when they reply, will say, thank you for all this information. We don't see any reason why you shouldn't qualify for SEIS or EIS. They are not rubber stamping it saying that you do. Okay, you do not qualify. You don't qualify or do not qualify for SEIS or EIS until it actually takes place. And you go to HMRC and say, this has taken place. It's all been done. Please rubber stamp it and do all the documents. Okay, because you could get the advance assurance and then the next day you could get £50 million investment and have £50 million on your balance sheet, right? Then that automatically makes you not qualify. So they're basically, it's a letter of comfort. It's not a letter that you do, but that comfort means so much to the investor. So unless you pivot, lots of things, different changing, there's no reason why between the advance assurance and the investment taking place that you shouldn't qualify, okay? But HMRC, very clever, they say, we see no reason why you shouldn't, but then it takes place and then they rubber stamp it and you do. So if you're ever thinking about this and raising in the UK, advance assurance, I think my colleague Rosie's turning these around in about 2-3 weeks. Again, I'd advise to get this and keep it in the locker. It doesn't run out because it doesn't mean anything, right? It's a letter of comfort. So it doesn't run out. There's no thing for it. And you can get a joint SEIS and EIS advance assurance as well to say we think you qualify for both. And it's great to have in the locker. Just have it. You know, if you're thinking of raising, if you're not thinking of raising, the worst thing you want is someone coming along 1st of April, got 5 days before the end of the tax year. They're an investor, an angel. They've got tax that they have to pay. They want to get tax relief. They're looking for investments. Do you have advance assurance? Do you have advance assurance? Right, they're going to go to the one that does. So it's very, very good. And it's, I mean, everyone should have it, shouldn't they, Simon? Really, if you're looking to raise in the UK.
Yeah, absolutely. It's a complete no-brainer. And again, it becomes one of those things on your tick list while you're, getting traction, getting to know people, and exploring the market. Absolutely.
Yeah, you don't want to be chasing your tail trying to get advanced assurance. You don't want an investor saying, I want to invest now. Have you got it? And then you have to try and put it in place. That's the worst thing. So I just put a bit of things about prices on there. You'll get large Big 4 accountants, top 10 accountants that don't deal with this too often, charging, lots and lots. You might find some cheaper than us. But it's not a loss leader for us at all, right? We make money on this and we do it. But what we hope to do is this is the start of a great, relationship with the companies. We help you get advanced assurance, which helps you get money. If you've got money in a business, then you need an accountant. We hope you come to us because we've helped you, and it's just a growing relationship. So advanced assurance is £250 plus VAT. And then if you do raise and subsequently get that investment, then it's another £350 per round to do all the figures, because you have to go to HMRC to say you've taken the investment. HMRC give you a certificate, which we have to complete, that you then give to the
no problem, Daniel. See you later.
Thanks, Daniel. So that's it. And we can do joint advanced assurance for SEIS and EIS as well if you're raising more than 250. So they're the only ones I touched on. We've got R&D as well, Simon, which I don't know if you want to ask any questions about. I'm pretty much on time. I'm thinking I was going way behind.
No, this was really good. I think R&D, we can talk to companies about a later date, because it's changed and it's very complex. And I think it is when you're, well, okay, just to mention it quickly, it's when you're doing something really unique and innovative through the UK company. So, those real scratch your head moments that your chief technology officer is wondering how he or she would solve that problem, that turns into research. But it's very tight. And I think for most of the companies coming into UK, it's going to be about market traction. And then you may end up doing R&D in partnership with a UK university in year 2 or 3, especially once you raise investment. Part of that might be to develop some further features and some back-end technology. But it's really getting into that sort of stuff. It's a great incentive, but I don't think it's one for us now.
Yeah, it's great. It's really tight. There are be careful. There are a lot of cowboys in the UK on it, but they're tightening up on them. But essentially, if you are doing very significant R&D in the UK and your business is loss making, what you do is you surrender that loss, like I was talking about earlier. You surrender that loss and you get money back from the government for that. So it great funds startups and gives you a bigger runway, really. But that's very technical and we can go into that. But any questions?
Sorry, you know what, Ed, that's a really good point. It's very attractive, and there'll be a lot of people phoning you up once you're a UK company registered as a technology company, and saying we can do this for you. But it's if you get it wrong, then you're on a naughty step with HMRC.
So I mean, the time now, but to get an example, I get people going into my DMs on LinkedIn saying, "Hi Ed, have you thought about R&D tax credits?" I'm like, do you not know what I do, right? It's just crazy. So any other questions? Do you have any, Simon, or any of the guys got any?
I think we've gone through ours. I'm just trying to, I did make some notes. Banking, advanced assurance, cost. I mean, I suppose there's one that I've got, which is a broad one. Anything that you feel companies get wrong when they're trying to run into this. I suppose we've covered a bit of it around timing and getting things in order. Anything else?
I'd say timing's a big one. Don't make too drastic decisions that are going to take a lot of time to unwind. I had to stop a company the other day from spending £10,000 setting up a company in Dubai they didn't need, right? On a hypothetical, I'm like, well, just hang on. So, don't run into things too quickly. Just think about things and what you need, and think about costs as well, and getting the right experts in place. Okay. And on the flip side, try not to do these things. They're incredibly important, so try not to do them yourself. You know, there are online things to do.
Yeah.
You know, set up your companies and things like that. Try not to do them yourselves because they're very easy to make mistakes, which cost a lot to unwind. On the flip side, you don't need to be spending tens and tens and tens of thousands on this as well. So get the right people, get the right advisor in place. That's what I'd say. I've seen people try to do SCIS and things like that themselves, and it's blown everything out of the water and made a massive mess at the stake of saving a few £100s.
Yeah, God, yeah, absolutely. I mean, if you Google company formation in the UK, there'll be a lot of services that come up. And, you know, if you understand, if you've run businesses in the UK before, then maybe it'd work. But I think at this stage, Sleek aren't going to charge you a huge amount to actually advise you and help you get it right. And as Ed said, they want the ongoing relationship, which is why we work with them.
Yeah, and we work with lots of incubators at universities where Big Four are embedded in there, and we work with like EY and things, and they refer some stuff to us, and I refer things to them. Right, I don't know about transfer pricing, multi-jurisdictional between the US, UK, and Vietnam. Right, that's not my expertise. So it's working hand in hand and getting the right advisors for the right thing. Really, that's what I'd say.
Great stuff. I'm gonna stop recording. I'm done.